Just want to welcome everyone to today's webinar to discuss the results of the 2018 Northeast Dairy Farm Summary. So Farm Credit East has undertaken the Dairy Farm Summary project for almost 40 years, looking at actual farm financial data for Northeast dairy farms. And there's a number of reasons that we continue this project. One, it's to help our own staff understand what's going on with the region's dairy farms, but also help policymakers and other stakeholders better understand the financial condition of this important industry. But really, first and foremost, our hope is that it's a useful tool for producers themselves, so that they can use the information to see how their farm compares to other operations, where they're doing well, and maybe where they can identify areas to improve. It's just one resource among many tools that we have in terms of consulting and benchmarking resources that Farm Credit East has for dairy producers. So just before I turn over Chris, I'll add on to Kyle's intro. The slides are included on the GoToWebinar control panel. It's under the Handouts tab. It's a PDF that's available there for you to view. And as Kyle mentioned, the webinar is being recorded, and that'll be available at farmcrediteast.com following the webinar today. So with that, I'm going to introduce Chris Laughton. He's the Director of Knowledge Exchange here at Farm Credit East and editor of the Northeast Dairy Farm Summary. Chris, I'll turn over to you.
Thanks a lot, Tom. Great. So let me begin the presentation here. As Tom said, the Northeast Dairy Farm Summary is really a rather unique project within the dairy world. We've been doing it for roughly a little less than 40 years, and it includes the financial results for more than 300 dairy farms. So in our agenda here, we're going to review the 2018 financial results. We'll have a brief panel discussion, and then we'll have some time for audience questions and answers. Our panel discussion following the main presentation will be Bill Zweigbaum, who's a Farm Credit East consultant, and Jan Bitter, who's a regional manager. So with that, I will go into some key points of the Dairy Farm Summary. As I mentioned, we had 305 farms participating in the 2018 Dairy Farm Summary. Having such a large sample size, excuse me, makes for a remarkably robust analysis of the Northeast dairy industry. Having a large number of farms in the study allows us to analyze the data in a number of different ways, and it reduces the chances of having our numbers skewed by outliers within the industry. It's really a testament to the large number of Farm Credit East staff who work on this project, compiling the data and reconciling information from all these farms and getting it into our system in a timely fashion. One thing that's important to note is that our sample of farms skews somewhat larger than the average dairy farm for the region. The USDA Ag Census tells us that the average herd size in the Northeast is somewhere around 130 cows. Our sample size in the Dairy Farm Summary is 478, so it's significantly larger than that. However, it should be noted that the USDA Ag Census counts a lot of dairy farms that have less than 10 cows, so are not perhaps commercial dairy farms. We do break down our results into 4 size categories: 0 to 99 cows, 100 to 299, 300 to 699, and 700 and up. So readers of the study can see data for the size group that they're most interested in. And our sample is pretty much evenly distributed among those 4 size groups. So we have a good representation of from pretty small to quite large dairy farms. The 2018 milk price came to $17.19, which was a pretty significant drop from 2017, $1.13 per hundredweight less. Also, net cost of production, and I'll talk about that a great deal in this presentation because we often get a lot of questions how we calculate that figure, came to 26 cents higher than 217. So a drop in milk price and an increase in net cost of production resulted in a net loss of about $40 per cow. That compares to $291 per cow gain in 2017, the year before. Productivity per cow decreased slightly, a little less than 1%, and that's an indication that farmers didn't really push their cows as hard for maximum production as they may have done in prior years, pretty much in response to the lower milk price. They may have shot instead for maximum efficiency and economized a little bit on feed and some other inputs rather than just go for maximum output. The result of all of this was that cash flow was insufficient to meet their expenses plus their capital debt service. So that resulted in a shortfall of a little less than 50 cents per hundredweight. And as a result of that, many farmers responded by increasing their total debt per cow. So that the total debt, meaning all liabilities, current liabilities, as well as lender debt, increased to $4,257. And so we'll go through all these bullet points in a little more detail in the following slides. So if we look at farm milk prices per hundredweight over a long period of time, this shows the average farm milk price received in the Northeast, as well as the 5-year average. We can see on the right-hand side of the chart the peak in 2014 and the pretty significant decline in the following 4 years after that. Prices declined in 15 and 16. We saw a modest recovery in 17, which led to that 290 roughly in earnings, positive earnings. And then we were back down in 2018. So 2018 was a down year in terms of milk price fluctuation. If we look at net margin, which is the difference between the milk price received and the average net cost of production, we can clearly see several peaks of positive net margin over the years. Years like 2001, 2004, 2007, 2011, and 2014 if we go left to right. However, in the last 4 years, that margin has been close to zero and a bit negative in 2018. This translates into net earnings per cow that have fluctuated pretty wildly over the years. We can see the peaks in various years, but in general, we often seem to return to that break-even point, which is the dark line in the center of the chart. One reason for this is that when earnings are high, farms tend to increase production, which often shifts the balance of supply and demand and results in lower prices. If we put a trend line into this chart, we can see that despite significant volatility and 1 year of significant losses in 2009, the overall trend of net earnings has been positive. Some have suggested that this volatility has actually been something of a positive and has helped boost average net earnings for those who can stomach the roller coaster ride. However, again, the last 4 years have been somewhat different. Each year has shown new net earnings below that trend line, and that raises the question of whether that trend will really continue to increase or whether we will see a new sort of reversion to the mean of break-even to modest earnings over the next few years. So getting back to net cost of production, the way we calculate net cost of production, there's a lot of analysts in the dairy industry that calculate net cost of production, and several of them do it in a little bit different ways. There's no sort of wrong or right way to do it. It's just a matter of what you choose to include or not include in the cost of production. For the purposes of our study, we look at cash expenses, that is what the farms actually spent on their inputs and their labor and the other expenses. So we don't include any adjustment for things like unpaid family labor, deferred maintenance, what the cost should be of various things. It's really just what the farms actually spend in terms of cash. And so we can see that that somewhat follows milk price to a certain extent, and that in a good year, farms may catch up on deferred maintenance. They may take a slightly larger family living draw, that sort of thing. But in a down year, typically if you don't have it, you don't spend it. So the farm's spending tends to decline. So in addition to those cash expenses, we add depreciation, which is a non-cash expense, but it's an important one because it measures the rate at which a farm's property, plants, and equipment is wearing out. So if you're not able to account for depreciation, you're going to be in trouble when it comes time to make reinvestments in the business. In addition to that, we add family living draw as a cost of the business because that's basically the owner's salary. That gives us our total costs, which some analysts consider the cost of production. But for our purposes, we then subtract non-milk income, non-milk farm income. So this does not include things like an off-farm job, which we call non-farm income, and that's accounted for separately. But it does include things like crop and livestock sales, which are integral to the farm operation, but not directly related to milk production. So we subtract those from the total costs, and that's what gives us our net cost of production. So we can see over time, over the last 5 years, that net cost of production has gone down from almost $21 to $18.36, $16.79. There was a little bit of a bump in 17, and then it increased further in 18, basically just as a result of general inflation and input costs, and farmers were unable to really tighten the screws any further on that checkbook. So this is a distribution chart that shows the net cost of production of all the farms in the study that we included. We often speak of net cost of production as it's a single number, but it's important to realize that each farm really has its own unique net cost of production based on the individual characteristics of that farm and their cost structure. The pattern of net cost of production distribution roughly follows what statisticians call a normal distribution, or a bell-shaped curve, in other words, where there's a cluster around the average and tails of outliers on each side. And the purpose of showing this is basically just to show that while the net cost of production came in at $17.72, and that resulted in a cash shortfall for the average farm, there were a significant number of farms that had positive net margins, and there was an equally significant number of farms that had more negative net margins than that average. We also look at net cost of production by region. So this shows the difference between 2017 and 18 calendar years from New York State to the New England states. And we can see a few different differences that are notable in this area, in this chart. Feed increased for both, actually for New York, but not for New England, although it remained significantly more expensive in New England than in New York. And there's a couple of reasons for that. One is that New England dairy farms tend to purchase more feed in general because they generally have less acreage to grow feed. So that means that they spend about $1, a little more than $1 per hundredweight on purchased feed. And that feed that they do buy tends to be more expensive by about 10 to 15% because there's a transportation differential. A lot of that feed is grown in New York, actually, and then trucked into New England. So there's a transportation cost there. Labor costs are generally higher by a fair amount. And then other expenses, which is basically just all the other categories rolled together, you can see that it's 50 cents roughly more than in New York. So everything is just a little bit more expensive. That results in cash expenses being a couple of dollars higher in New England than in New York. Depreciation and family living are roughly the same. Total costs, again, about $2.50 higher. Non-milk income is lower in New England than in New York because, again, for crop and livestock sales, they tend to have a little bit less of that. So you boil that all down, and that results in net cost of production being about $2 higher in New England than in New York. New England dairy farms do receive about 50 cents more per hundredweight in milk price because they're closer proximity to the major population centers of Boston and other New England cities. So you don't have to truck the milk as far, and there's more Class 1 utilization. But that doesn't make up for a $2 difference in net cost of production. So the financial results that we see were better in New York State than they were in New England. We also see a range of profits across the study. We break down the profits of farms into four profit categories. We look at the top profit quartile, 2 in the center, and then the bottom profit quartile. And here we can see some statistics on the average number of cows per herd size in the top and lower quartiles. Milk sold per cow, we can see that the top 25% tend to have a higher production per cow. That translates along with labor efficiency into more milk sold per worker, which is a key measure. So the net earnings are a pretty broad spread. They range from a loss of almost $2 per hundredweight to a gain of a little over $1 per hundredweight. Or to translate that into an overall farm earnings for the average farm size in each category, that could mean the difference between a loss of close to $200,000 for your farm or a gain of over $120,000. So again, there's a range of results. Roughly 40% of the farms in the study had positive net earnings at some level, and roughly 60% had negative net earnings. So it wasn't a great year, but many farms did manage to achieve positive earnings despite that. So moving on to cash flow, which is a little bit different than net earnings. We look at milk price, the cash required, the other income, that we subtract that's that other farm income that I mentioned earlier, the crop and livestock sales, and for some farms they may have things like maple sales or other ancillary business activities. That results in a break-even milk price. And what that means is that's the price at which farms can cover their cash expenses, including their debt service. So that's a little bit different than what we call the net cost of production, but they're not far off. But the bottom line is that resulted in a negative cash margin of minus 49 cents for 2018, which adds up. That's a fairly significant loss. And unfortunately, that follows 3 years of shallow losses, just a little bit below break even for 15, 16, and 17. So what that means is that cash was extremely tight for the average Northeast dairy farm, and the money basically went out as fast as it came in. So many farms dealt with this by restructuring their debt or increasing borrowing or pinching pennies in other ways, selling some capital assets, that sort of thing. If we look at that cash flow graphically over time, we can see that net earnings were, within a sort of range of $1 to $3 prior. And we had 2014's remarkable profitability, which I don't think we've seen since or before or since. And then you can see the 4 years of negative net margins that we've seen since then. So I mentioned that farms basically had to find a way to make ends meet. And one of those ways was to increase their average total liabilities. So that could take the form of restructuring long-term debt, terming out a line of credit that they're not able to maybe pay back fully, extending trade payables, or doing other short-term debt extensions. And so what this chart looks at is the average total liabilities per cow from the beginning of the dairy farm summary until last year. And the bars represent kind of thresholds of $2,000, $3,000, and $4,000 per head. And what's remarkable about this chart is that it shows that we took almost 30 years to get from $2,000 to $3,000 per head, but we went from $3,000 to $4,000 in just about 8 years. And then we can see a little bit of an up and down in recent years, and we're now at about 4,200. That's not quite at a crisis point. Most farms can handle that amount of debt and are able to do so successfully. But what's concerning a little bit is the trend over time. That long period of time when we hovered between 2,000 and 3,000, and then the significant increase in recent years. Now, inflation has something to do with this, and I'll show you a chart here in a minute. This shows the inflation-adjusted average total liabilities per cow. So we can see that we've seen dairy farms be significantly leveraged, even more so than they are now, in the 70s and 80s. But for those who remember that time period, that wasn't really a great period for Northeast agriculture or agriculture in the whole country. And then that leverage came down, affected mostly by inflation. But then we've seen, again, an uptick in recent years. So it's something to pay attention to. I don't think it's a crisis, but as I said, but it is somewhat of a concern. So that's why I brought that chart together. So as farms need to manage their debt obligations, one of the things that we look at is what's called the current and quick ratio. And what these do is they're essentially a measure of the farm's ability to pay its bills. They look at current liabilities and compare them to current assets. The current ratio looks at the overall current liabilities of a farm as compared to current assets of a farm. So that's basically the obligations that will be due within a current year, within 1 year, and then assets that are either cash or will be turned into cash within a year. So as we can see, that's gone down a little bit in recent years from close to 3 to close to 2.5, but that still means that the average farm has 2.5 times the current assets as it does current liabilities. So that's a pretty healthy position to be in, really for any industry, not just dairy. However, much of the assets on the dairy farm are in the form of feed stored in the bunk that is not necessarily going to be turned directly into cash. It's going to be fed to the animals, which in turn will make milk, which in turn will generate cash. So when we look at quick ratio, that takes out that inventory and looks at basically only cash and things that could be quickly converted to cash, like stock investments or that sort of thing. And we can see that that's below 1. It's between, it's around 3/4, 0.75. That means that farms have roughly only about 3/4 of the amount in cash as they do current liabilities. So that means in shorthand that the farms are relying on that milk check to come in every month, and most of it goes out right away for current obligations. So the bottom line is that the money went out as fast as it came in 2018, and a lot of farms struggled with cash flow. So to draw some conclusions here, profitability in 2018 declined to a net loss, largely because of a decline in milk price. However, a wide range of results continues, with many farms earning money. We had some farms that earned as much as $2,000 per cow that were remarkably successful. We had other farms that lost similar amounts. We did see positive correlations between farm size and profitability. Larger farms tended to do better overall. However, it's important to note that not all large farms did well. Some large farms lost large amounts of money. So it's important to note that growing in size is not always a guarantee of success. And also to note that our top 25% profit quartile included farms of all sizes. We look at profit per cow, not overall dollars per farm. So some farms that had relatively small herd sizes were actually remarkably profitable in terms of their returns per cow. Another noteworthy item is that farms in New York generally showed lower net cost of production, even when sizes are adjusted for average size. So it's not just a matter of New York farms being bigger, it's the geography that makes a difference. Many farms struggled with cash flow last year. And it's one thing that I should note, kind of in closing off, is that milk prices have risen since last year. 2018 was a down year. We've seen some recovery since the trough in the middle of last year, and 2019 should hopefully show better results. We're already seeing milk prices quite a bit above what 2018 had. It's not fantastic, but it's definitely an improvement. There's a lot more in the report. There's only time to go through some of the highlights in this presentation, but I want to mention that the full report is available as a PDF file at farmcrediteast.com under the Knowledge Exchange page. And I also want to mention too that the Dairy Farm Summary is really only the beginning of benchmarking. We cover mostly financial topics in the Dairy Farm Summary, but for producers that want to do a deeper dive and really take their farms to the next level, our Success Strategies Benchmarks, which is a paid program, does a much deeper dive into both financial as well as operational metrics, and can give producers really a good idea of how their farm is performing, how it compares to peers of the same size, and areas for improvement, as well as areas where they may be doing well. So I wanted to mention that program exists for farms that want to go beyond what's in the Dairy Farm Summary. So just getting into the present situation a little bit, there's a couple encouraging trends that we're seeing. One is on the left-hand side chart is the herd size of U.S. milk cows from 2015 to the present. We can see that in 15, 16, 17, and maybe a little bit into 18, despite relatively low milk prices, the herd size across the country still managed to increase. What that meant is that just extended the period of low milk prices and also caused some marketing challenges of having some areas having trouble just finding a home for all the milk, let alone at whatever price. However, since January of 18 and into 19, we've seen a decline in the herd size, and that's an encouraging trend because it means that supply and demand is going to come closer into alignment. Some of those milk marketing challenges where co-ops in the Northeast may have had to haul the milk very far to be processed or that kind of thing outside the region Hopefully some of the pressure will be off on that, and we'll hopefully see some recovery in milk prices. However, it's important to note that even though the herd size is declining, the cows that are left are more productive. So the impact on overall milk production is not quite as dramatic. If we look at on the chart on the right, we can see that there's a really significant seasonal variation in milk production, but that sort of green trend line in the center there, we can see that as we go from the left to the right, it was climbing up through 18, and since then it started to level off, which is a good thing for supply and demand to balance out. If we look at global milk production change, this chart here looks at milk production from the 4 major dairy exporters in the world: Australia, New Zealand, the United States, and the European Union. And again, as the previous chart showed, we saw some increases in milk production, pretty significant increases in 15 and 16, beginning of 16 rather. That turned into a decline mainly because of Europe. Then 17, Europe came on again strong, but in 18 and going into 19, that increase in production has declined and is maybe even a little bit negative at this point. So that's a really good sign for global supply and demand balance. And it means that the U.S. will be in a better position to export more milk and or more dairy products rather than fluid milk, perhaps. Things like powder, butter, cheese. And that's a very important thing for our domestic milk prices. We're now exporting about 15% of our production throughout the country, and that's pretty significant. So that change in increase in production will hopefully lead to a greater realignment of supply and demand globally. So what's that mean for prices? So this shows the average price paid by 2 prominent Northeast cooperatives over the last few years. We can see the bars at January of each year. So again, 15 was a moderate level year of price. 16 was down. 17 was back up a little bit. 18 was down again. And then in 19, we've seen prices climb, and they're projected to climb through the end of the year. So hopefully that will lead to somewhat better results, something like what we saw in 17 or 15. And with that, I will turn it over to our panel for Bill and Jan to give some of their comments.
Thanks, Chris. This is Jan. And as I looked at the benchmarks from a credit perspective, I'd have to say that the numbers are pretty representative of what we've been seeing as we're servicing credits this spring. Most farms have worked pretty hard to control their costs. You'll see that non-farm income has increased a bit. We're seeing that too, where a spouse takes a job off the farm to supplement income or bring in some health insurance. I noticed that average capital sales last year were $96,000, up from an average of about $23,000 in the 3 preceding years. Last year, we had a number of farms who were selling off timber or extra acreage to help cover their cash flow shortages. I noticed too that the livestock inventories are lower than in previous years. There may be some revaluation shown there, but we've also seen farms carrying lower heifer inventories than in past years. They're trying to reduce costs, especially when some milk markets are limiting production increases. I see these as coping strategies, farms doing what they can to get by. In some cases, these strategies have been enough to allow the farm to maintain net worth. In other cases, those actions couldn't cover the farm losses. And so we're also seeing, just as in the benchmark, a buildup in accounts payable. The bottom profit group in the study had $243 per cow in open accounts, and we're seeing numbers quite a bit higher than that in parts of our dairy portfolio. Total liabilities have climbed over the last several years, and long-term debt has been growing. In many cases, that reflects what Farm Credit and other lenders have been doing to restructure debts over a longer term to improve cash flow. Net worth declined last year, but it's still pretty strong at 66% of total assets. Over the last 5 years, percent net worth has gone from 75 to 66. Again, that's pretty typical of a lot of farms we work with. So, the fact that many of our farms have strong net worth is one of the things that gives them some staying power through hard times. And you have to love the adaptability of our farmer customers. If you take a look at how much farms have shaved off their costs in the last 5 years, it's pretty impressive. The top 25% of the benchmark have a net cost of production of $16.57. I put them up against farmers anywhere in the country. And look at labor efficiency. On average, we're at 1.2 million pounds per worker. That used to be unthinkable 10 years ago. That's pretty darn good. And for farms that have taken the steps to become more efficient and to control costs, I'm pretty optimistic. Last year's break-even milk price for the benchmark average was $17.68. And as we're looking at a milk price at least $1 higher than in 2018 this year, we're thinking that many more farms will cash flow this year than they have in the past. So I'd like to leave it on that positive note, if I can, from the credit shop.
Great, thanks, Jen. So this is Tom here, and I'm just, before we turn it over to Bill for his comments, just want to remind folks that on the GoToWebinar control panel, there is a kind of a questions tab. If you want to, if folks have any questions, they can type those in, and after Bill's comments, we'll address those. Bill, why don't you go ahead?
Okay, so I was going to take a little time here to talk about what we're seeing more recently than 2018 in terms of the kinds of changes people are making in order to adapt to this low milk price environment and long-term lack of significant profitability. This has become a real concern for us in the consulting group because for those that are already unable to cash flow their existing operations, continued reinvestment becomes much more difficult. Jan already touched on, the great emphasis on cost control that we see, and she touched on reductions in heifer inventory. I just wanted to add to that, having done some calculations out of the data, that a reduction in heifer inventory by approximately 30%. So in other words, if say your cow to heifer ratio is at 100%, if you were to drop heifers down to 70% of cow numbers, that actually translates into about a 53-cent reduction in net cost of production. So those are a lot of extra mouths to feed that may in fact not be needed any longer, given that we're having some difficulties with oversupply, and a lot of milk handlers are encouraging farms to not continue to increase. We've also found some very low cost kinds of things that people can do to help enhance profitability. One of those that we've been talking about a lot in the last year has been for those farms that feed cows once a day, a conversion to 2 times a day feeding has resulted in pretty significant results, net margin improvements on the order of 75 cents a hundredweight for those that have switched to feeding once a day to feeding twice or more per day. And for those farms that are still milking 2 times a day, conversion to 3X is starting to gain some traction. People that previously had resisted due to labor constraints or other circumstances are now starting to realize that they may not have a choice but to move on and milk more often in order to get better milk production per cow and higher efficiencies all the way around. So those low cost, high return investments have become very popular. We're also seeing some pack mats, which are basically a sand saver in stalls that are bedded with sand. They can reduce actual sand purchases by as much as 40%. Which can convert into 10 or 15 cents a hundredweight in cost savings as well. The other thing that I wanted to comment on is that typically our universal answer for how to improve profitability has been to expand our herds, and we still see a tremendous amount of herd expansion going on in the Northeast, particularly among our more progressive and most profitable farms. In the Success Strategies Dairy Benchmark program in 2018, our average participant added on about 12% more cows, so very significant growth. And one of the things I wanted to touch on here is that we need to ask a few questions of those customers that are thinking about herd expansion. First of all, we need to look at their gross margin. And if you go to the Blue Book and look in the A tables, you can see net cost of production calculations in a gross margin format. For herds that do not have strong gross margin but maybe have low overhead, expansion is not going to really be a successful strategy financially. The other things that we need to think about with these customers are, do they have the labor in place, and is it a stable workforce in order to be able to accommodate an expansion? And lastly, and this needs to be a very frank conversation with people, is do they have the management skill sets to go to a different herd size and continue to be top managers? So those are kind of the things that I wanted to point out from the farm side of what we're seeing most recently.
Well, great, thanks, Bill. Appreciate those thoughts in terms of what you're seeing kind of out there, you know, on the ground, as it were. So we got a few questions I'm going to kick around to our panel and to Chris. Before I do that, I do want to point out that the PDF of the full report is available at farmcrediteast.com under the Knowledge Exchange section under Reports. So obviously the slide deck here covers a lot of the high-level takeaways, highlights of the report, but the full report, including the appendices that Bill just referred to, is available at farmcrediteast.com. So the first question I'm actually going to send right back to Chris here is in terms of benchmark data on organic herds. And first of all, is that included in this? And Chris, why don't you comment on that?
Sure. We do finance organic as well as conventional dairy farms at Farm Credit East. And so we have relationships with quite a few organic dairy farmers, and we specifically do not include them in the dairy farm summary because their economics are quite a bit different. We do a much smaller benchmark for organic dairy. The sample size is not nearly as big because we just don't have as many participants, but we will have one. It will be released publicly. I don't have a date on that, but within the next couple of weeks, we'll have posted to our site an organic dairy herd benchmark. I'll mention a couple of things that we found on that. One is that their finances tend to be better. They get a significantly higher milk price, of course, as you would imagine. Their expenses are also higher. They have a higher feed expense for certain because they have to use organic feed, of course. They have to pasture their animals for a good chunk of the year, so that adds costs. So higher revenue, higher cost, but the result is that they did achieve greater profitability than the conventional average. However, I do want to note that the organic market is having some of the same challenges as the conventional market is lately, in that they're seeing a little bit of oversupply. Some of the organic co-ops are limiting new entrants, so it's not necessarily a cure-all for the industry. But yeah, the short answer to your question is yes.
Okay, great, good to know. Another question came in, and Jan, I'll have you comment on this one. Question came in, kind of given the challenges in the industry right now. Any noticeable changes in land prices related to areas with significant dairy production?
We have not seen changes. There had been a pretty strong run-up in good tillage values over the last 4 or 5 years. But I would say that movement of land has slowed way down, so we're not seeing nearly as many transfers, but it does not seem that the price is dropping, and it doesn't seem to be going up either.
Okay, good, thanks. Bill, any comment on that one from your perspective?
I tend to see the same thing. You know, I'm looking at appraisals from time to time as working with farmers, and am not seeing any declines in value.
Okay, good to know. So a question came in from one of our New England offices. I'll have Chris comment first. You know, given that sort of on average higher cost of production, you know, what are some of the things New England dairies might consider. Chris?
Okay, yeah. New England does have some significant differences from New York State or other states. Everything seems to cost a little bit more. The state support programs do help a lot. Connecticut, Mass, and Maine have state support programs for dairy farms, and those do make a big difference. We also see a lot of innovative practices or innovative ideas happening in New England. We're seeing more farms add sort of ancillary business operations to their operations. Like a lot of farms are doing maple. They may be adding digesters. They may be seeking for these other sort of additional sources of revenue that are making a difference. We're also seeing an increase in direct marketing, farms that are doing on-farm processing. There's a few co-ops. Well, it's not a New England example, but Hudson Valley Fresh. It's similar sort of more urbanizing area. And then in New York and Connecticut, we have Farmers Cow, which is another sort of local cooperative that's getting a little bit higher milk price. So they're doing more innovative things. The proximity to markets and the higher Class 1 utilization does help them. So yeah, New England dairy farms are facing some real challenges, but there's some potential there too.
Great. Question on robotic operations. Chris, I know you've taken a look at that.
Yeah, we're in the middle of doing a robotic benchmark, and we're kind of analyzing the data as we speak. So I don't have firm conclusions on it, but some things I can tell you are that in general, we're seeing a major increase in interest in robotics. That this follows increase in labor costs, but more than that, just finding the labor period is a challenge. So, at any cost. So we're seeing an increase in interest in robotics. A few things that we've noted. One is that the distribution of results is very, very wide. So we're struggling a little bit with drawing firm conclusions on the impact of robotics on operations, because some farms have seen significant decreases in labor costs and increases in production because of more frequent milking. Other farms haven't seen quite as much, so stay tuned on that one.
Okay, great. I'd ask Bill and Jan for a comment in terms of robotic operations. Bill, do you work with any customers that have installed robots?
I do have a couple customers that have installed robots, and I think one of the things that we've taken away in those operations is that although when we initially budgeted them and working with some data provided by the manufacturers, we thought there was going to be more significant labor savings than we're actually seeing in reality. That's a little bit of a complicated thing, because some of it is family labor who you would expect is going to not be let go just because there's a change in the way things are handled. But the biggest thing, besides the fact that you are expecting some labor savings, is that for most of these farms that are going into robotics, they're also being able to make a change from 2 times a day milking to roughly 3 times a day milking. And they're able to spend more time on, actual management, looking at animals, correcting health problems quicker, doing a better job of heat detection and breeding as a result. So there's a lot of sidelines there that we haven't really been able to quantify in a dollars and cents way yet.
Good. And Jan, I know Farm Credit East is financed some of these operations. That when looking at a credit decision, what are some of the things you look at from your chair?
Well, unfortunately, we're going to give those robots a pretty hefty charge of lost capital, and so meaning the depreciation in year 1 is fairly significant. And so if a farm is not in a pretty strong equity position to begin with, they may find financing a little more challenging because of that lost capital factor. And in general, I think most of the farms find that there's kind of an adjustment period where they figure out how to make use of all that management information that is available through the robot. So Don't underestimate the amount of time it takes to adapt to the robots for both you and your cows. But I don't know too many people who've gone to robots who wish they could go back.
Interesting. Okay, good perspective. This is kind of a methodology question as well as one in terms of what we're seeing out there in the marketplace, which is looking at livestock values. So I guess I'd ask Chris first from the methodology and the study itself, how that's taken into account in preparing the results.
Yeah, thanks, Tom. We did drop livestock values on people's balance sheets at the end of 2018 as compared to the prior year, but probably, to be honest, probably not as much as we perhaps should have in terms of a true market valuation. One of the reasons for that is we wanted the results of the Dairy Farm Summary to focus primarily on the earnings of the farm operation and not skew it with major changes in revaluation of livestock. So we did hit the livestock values a little bit, but the reality is that farm livestock values are probably even a little bit lower than what we put in there.
Okay. Jan, what are you seeing from a livestock value perspective, from your perspective?
Well, our appraisers collect sale data from auctions across the Northeast, and at the beginning of each year, they come up with a range of values. Generally speaking, that's based on the production levels of the animals. So what we did lower the range of values this year, perhaps not as much as some people would think we should have, given some of the really weaker auctions that they've probably heard about. But our underlying assumption is that these are animals that are going to be maintained in the herd and are being well cared for and might be purchased as a complete group by another farm. So some decline in values, but we're not slashing and burning cow prices.
And Bill, you had mentioned kind of in your comments, a strategy of sort of raising fewer replacements. How do livestock values kind of factor into that decision?
That's been mostly done, number one, as a way of controlling costs, and number two, as a way of trying to find a better balance for those herds that are not growing, because there isn't a good cash market for surplus heifers to be sold as there historically has been. If I could address the value issue, we've kind of taken two approaches to that with our success strategies benchmark. One approach is to lower valuations to market and absorb that as an accrual adjustment that reduces earnings. The other strategy has been to go back and also change prior year balance sheet values so that we're really looking at earned net worth changes as opposed to revaluation changes, so that we can utilize that information for management purposes. That's not the way it's going to be done for credit, obviously.
Okay, great. So one final question here that we'll do. This one's kind of a broad-based look here at global demand for milk in terms of the question asker mentioned sort of soy beverages and other plant-based beverages, but I think it gets to a larger question of kind of demand for dairy in general and kind of its share of stomach. Chris, what are your comments in terms of kind of overall dairy demand?
Sure. There's kind of two answers to that. There's the U.S. market and then there's the international market. In the U.S., it's true that we have seen declining fluid milk consumption. That's a trend that's been going on since the 1950s. In recent years, the soy and other plant-based alternative milks, if you want to, whatever you want to term them, those do seem to have had an impact in the last few years. So we are seeing in general a decline in Class 1 utilization in many American areas. Having said that, overall dairy consumption on a milk equivalent basis is increasing because we're not consuming as much fluid milk, but we're consuming more processed dairy, more yogurt, more butter, more cheese. So It changes the market dynamics a little bit, but it doesn't make that the dairy market is just declining overall. Internationally, it's a little bit of a different story. I've been to China many times, and milk consumption there, or dairy products in general, is there. Well, first of all, China is the #1 dairy importer in the world, and their consumption of dairy is still very, very small. And but it's growing, and you multiply anything by 1.3 billion people, and you get a big number. So they're seeing dairy, both fluid milk as well as cheese, become a bigger share of their diet. And so I think dairy product consumption globally is going to continue to grow, but those plant-based beverages are having an impact in the fluid milk market.
Okay, interesting. So one more question did slip in under the wire while we were answering that one. On sex semen. Bill, interested in your take on sex semen, other genetic testing as well, in terms of the bottom line for producers you work with.
Okay, so we are seeing a decline in the use of sex semen, and not a real significant decline, but from about a 14% level in 2017 to about a 12% level in terms of all breedings. The other thing that we have been seeing is an increased utilization of beef semen on the lower part of the dairy cows in order to, #1, improve the overall genetics of the herd, and #2, have a more valuable calf for resale in the beef market than what a Holstein bull calf would bring.
Okay, good, interesting. Well, good. Well, I think those are all the questions, so I think we're going to wrap it up here. I just want to thank Jan and Bill for their participation and their comments. Thanks, Chris, for his hard work on the Dairy Farm Summary. As I mentioned, that report is now available on farmcrediteast.com, and we are going to be printing copies, which we will be getting out to Farm Credit East offices. Just want to thank everyone out there on the line for joining today. I appreciate your participation. Please check back at farmcrediteast.com/webinars for future webinars. I know we have one on ag labor coming up on May 22nd. And so you can please tune into that one at the time. But again, thanks for your participation, and hope everyone has a great day. Thanks.